Hello, everyone. Welcome back to another episode of The Week in Charts. I'm your host, Charlie Bilello, bringing you once again the most important charts and themes that I'm seeing today in markets and investing. If you're watching this on YouTube, take a quick moment and hit that subscribe button for all the latest content from us. We have a big show for you today, a lot to discuss. Market making fools of all the soothsayers out there. Once again, there is no impossible in markets. This is one of my favorite sayings, and I'm going to show you the latest example of this. All-time highs again in the S&P 500. We'll discuss that. 3 rate cuts in 2025. Is that possible? Well, that's what the market is now expecting. I'll show you the latest data there. What is the most important jobs market indicator to watch? It is not the non-farm payroll report that we're going to get this week. I'll talk about what that is and what you should be watching there. An inflection point in the housing market certainly seems like it. We'll discuss that. Very important trend going on there. And we'll end with something positive, as we always do. That would be the office conversion boom. Okay, let's start out here with the markets here, making fools out of the soothsayers, the predictors once again. And here's the latest example here. A week ago, last weekend, the U.S. bombs Iran, hitting their nuclear sites. And this was the headline here. Investors brace for oil price spike, rush to safe havens after U.S. bombs Iran nuclear sites. So the predictions, the experts were all out during the weekend saying this is going to be a big decline in the stock market. We're going to see the price of crude oil spike. And if you looked at futures that night, initially, stock market was down, crude oil prices were up. But let's fast forward here to the end of the week. This is actually what happened here. Stock market ending the week up 3.5% higher, the S&P 500, hitting a new all-time high, as we'll talk about in a little bit. But probably even more surprising was the action in crude oil. Crude oil prices down 12%. And look at the volatility index, the VIX, actually crashing down over 20% on the week. So if we told you this headline and told you nothing else and asked you to predict what the market was going to do over the following week in terms of stocks, in terms of crude oil, you most definitely would not have predicted this, which is why I say the market always makes fools out of the predictors given enough time. It's very hard to predict what the market is going to do, even if you knew the news in advance. So let's talk about this concept that I like to point out each and every year. There is no impossible in markets, and the latest example is the unbelievable comeback in the U.S. stock market. So this was the 4th worst start to a year in history. If we go back to April 8th, you probably remember this table that I was showing you at the time. And what we said at the time is the year's not over. Anything could happen. Even in looking at the first few examples here, you saw the S&P 500 did rise after the worst starts, 3 previous worst starts in history. They did rise, and in 2020, we actually saw the S&P 500 finish with a strong return that year. So it was not seemingly impossible for this to happen, but it certainly felt like that. And if you were reading the headlines on April 8th, they certainly weren't suggesting that the market would end the year positive or recover from this drawdown so quickly. Now, what has transpired since then? One of the biggest short-term rallies we've seen in history. And here's this chart I'm showing you of the S&P 500 versus every other year going back to 1990. You can see here in the green line is this year. There it is, one of the worst starts we've seen on record. And the huge advance since has now pushed the S&P 500 total return, so including dividends, up 5.6% now, and is actually slightly above where the average year is at this point in time. So if you didn't look at the market at all and you just started looking at the market today, you would say pretty good year so far. We're actually above average in terms of the return here for the S&P 500. And how do we get there? Well, it's this enormous rally we've seen over the past 12 weeks. It was actually 22% rally looking at weekly prices here for the S&P 500. That was good for 10th best going back to the inception of the S&P 500 total return index in 1989. You can see some of the other dates here you'll be familiar with because they were historic bottoms in the market. We're talking March 2009, March 2020, 1998 after that 20% bear market. And so here we are, 2025, one of the biggest short-term rallies in history. And I've shown different versions of this chart over the past month, looking at prior examples of these huge advances and essentially asking the question, well, what has tended to happen over the following year following these enormous advances? Do you tend to see a huge pullback over the next year? And the answer, and this is still consistent, is not really. You tend to see this strength be followed by more strength. Looking at the one-year returns following these big 12-week advances, you can see all of them positive over the next year, all of them actually double-digit percentage gains, and you could see above average returns looking out 6 months, 12 months forward versus all other time periods. So will this happen again? We have no idea, but there's nothing to suggest that just because the market has run up big in the short run, that it has to go down or that it can't keep going up. And if we look at the volatility index, even more stunning than the huge rally in the S&P 500 is how quickly the VIX, the volatility index, has collapsed here. Biggest crash in history for the VIX. We're looking at 12-week percent declines, and it's 64% over the last 12 weeks. So we were at 45 at the end of April 4th here, ending that week, and ended last week at 1632. That's a 64% decline. And similar to the S&P 500, huge short-term rallies, we can see here most of the time the S&P 500 is positive over the following year, and you actually see on average better than average returns following these VIX crashes. So once again, nothing to say that a huge decline in volatility means that the market has to go down. And I just wanted to show you the visual of that VIX because it's absolutely stunning to see that spike that we saw back in April actually went above 60 at one point in time, one of the biggest short-term spikes in volatility that we've ever seen. And now we're all the way down to 16, lowest close that we've seen for the VIX since February 20. So if you're thinking about your portfolio here after all this crazy moves in the market in the first half of the year, you're thinking about how to position for the second half of the year. At Creative Planning, we can help you with all of that and more. So reach out to us today at creativeplanning.com/Charlie. Fill out this form to get a free wealth path analysis from us where we're going to help you with your portfolio, with your plan, with your tax situation, and much more. At Creative Planning, we're in all 50 states, so we likely have a location right near you, over $350 billion in assets under management and advisement, and we're here to help. So reach out to us today, creativeplanning.com/Charlie. Let's go to number 3 here, all-time highs again, and this is the visual of that S&P 500 index. 20% decline, very fast bear market, similar to 2020, not as fast as 2020, but pretty rapid decline here from the February high to the April low, 21%. And now you can see here, climbing out of that, a 28% rally off of those intraday lows on April 7th to hit a new all-time high in the index. And on a closing basis, that's the 4th all-time high we've seen in 2025. You can see that follows 57 in 2024, which was the 5th most in history. And we got to go back to the data in terms of all-time highs because we get this question all the time. What does the market tend to do following all-time highs? Well, it tends to see more all-time highs. There's nothing particularly bearish or there's no signal in that all-time high, and you can see that from the data here. I went back to to 1929, looking at the S&P 500 each time that it's hit an all-time high. Well, what has it done on average going forward? And looking out the next year, you can see still a 10% average return going forward. So yes, eventually there will be an all-time high, after which there will be a bear market, just like we saw in February. But just because the market is not at an all-time high doesn't mean you should expect it to go down going forward. It's not a reason by itself to make any changes in your portfolio. Okay, let's go to number 4 here. 3 rate cuts in 2025. This would have seemed ridiculous just a few weeks ago, but now that's actually what the market's pricing in. And it's incredible to me, given these other factors that are going on. And I outlined this on a post on X this weekend. Stocks that are at an all-time high, home prices in the U.S. all-time high, Bitcoin all-time high, the money supply in the U.S. back at an all-time high, U.S. national debt, of course, at all-time highs. And then you have inflation, which the Fed is supposed to be targeting 2%. And that's been averaging 4% since the start of 2020. And now you have the Federal Reserve expected to cut rates by 3 times by the end of 2025. And here's the curve here in terms of Fed funds futures, what they're projecting here. And you can see ending the year at 3.68%. This is the current expectation. And then in 2026, the market's expecting 2 more rate cuts, bringing that Fed funds rate down to 3%. So in terms of the meetings here, the next one we have is July, and the market is still expecting the Fed to stay on hold during that July meeting. So essentially they're saying we're going to get 25 basis point cuts in the meetings in September, and after that heading into December. So the few meetings after that July meetings, but we're not going to see it in July. At least that's the expectation right now. And much of it is going to hinge, I think, on the inflation data that we get over the next few weeks. And looking at core PCE here, again, the Fed has a 2% target, and this is their preferred measure of inflation, and it's still at 2.7%. So we haven't even gotten to 2% in their preferred measure of inflation. So everybody saying that the Fed needs to cut now, they should be cutting right now because inflation is lower. Yes, it's definitely lower than a few years ago, but it's not even at their 2% target. And if we look at the cumulative inflation over the past few years, it's actually well above the target, more than 2 times if we're looking at CPI. So what I've been saying is the Fed is actually correct. I believe they should not be cutting rates this year at all, given the situation in terms of stock prices, in terms of home prices, in terms of inflation still being elevated. There doesn't seem to be a big need to cut rates unless you're talking about the national debt and really trying to bail out the federal government in terms of lowering their interest payments. And now that seems to be a big part of the push for the Fed to cut interest rates. But if we look at the CPI here, the trend is definitely lower. We got a core CPI reading of 2.77%, 2.35% on the headline reading last month. But before the Fed meets again in July, what they're going to see is inflation tick up again. This is from the Cleveland Fed, who's usually pretty close in terms of their expectations. They're expecting CPI to jump up to 2.6% for the month of June and core CPI to get closer to 3%. Now, if this is how the data comes in, I think it would be very difficult for the Fed to start cutting interest rates in July, given all the other factors that I've been talking about. So likely to be another month on hold unless we see something else going on in terms of employment weakening or inflation actually coming in much better than expected. But clearly the market is thinking that the Fed is going to cut this year, and the market's leaning towards more rate cuts, not less. And I think a lot of that's coming from the statements coming out of the Fed governors, not really Powell, but if you listen to some of the statements from the other voting members of the FOMC, they've been talking more about rate cuts in recent weeks. And that's really, I think, driving these expectations that the Fed is going to continue their easing cycle that they started last September. Okay, let's go to number 5 here. the most important jobs market indicator to watch. We're going to get a non-farm payroll report this week that's going to show the jobs that were added for last month, but that's really not the indicator to watch. It's often highly revised, subject to massive revisions, and it's a very volatile number. I think a better number to look at is going to be jobless claims and continued claims. And if we're looking at the labor market as a whole, what I've been talking about is that we've seen this gradual loosening in terms of the labor market. And in particular, we're seeing it among white-collar employees. This is interesting data from Live Data Technologies looking at the percent change since the end of 2021 in terms of white-collar employees at U.S. publicly traded companies. And what you can see is declines in staff and executives and managers, down close to 6% in terms of the number of employees. So S&P 500 companies are pulling back, or at least not on a massive hiring boom. And there was an interesting data point that 1 out of 5 companies in the S&P 500 actually has fewer employees today than they did a few years ago, which is not the typical trend. And if we're looking at where they're cutting in terms of these white-collar workers, you can see it's pretty much all departments with the exception of legal here. We're seeing human resources, sales, operations. So across the board, seeing these types of declines. Now, these haven't been huge so far, but what we've seen is a gradual tick up in terms of the number of layoffs, and we've seen the hirings in terms of public companies actually go down. So this is helping profitability, and we've seen companies like Microsoft, I'll talk about this next week, hit all-time highs every single day, and they seem to be continuing to announce new job cuts, and the market's viewing that positively because they're saying that's going to help the bottom line of the companies. But if we're looking at this indicator to watch here, once again, I would be looking at jobless claims, looking at continued claims, so people that have filed for unemployment insurance and have continued to file for that insurance, meaning they're having a hard time getting back into the labor force. And what you can see here is it's not a huge spike, but you can see the trend is moving in the wrong direction. We're now at the highest levels we've seen since November 2021. So continue, I would say, to pay close attention to this number, much more indicative of what the jobs market's doing than that monthly non-farm payroll report. Okay, let's go to the housing market. Big inflection point, I would say, going on there right now. We've been waiting for this. We've been talking about this month after month in terms of the supply picture versus the demand picture. But I think we're finally at the point where we're at an inflection point where we're going to see changes in prices, and perhaps changes in prices moving lower because the supply is picking up and demand continues to be very low because of the lack of affordability. So what I'm showing you here is the existing single-family home inventory in the U.S. It's now at its highest level since June 2020. So very good news. You can see we hit a record low back in early 2022, and that was helping to drive continued price increases in terms of the housing market. There was just so little inventory for sale. If we look at new homes for sale, highest level, it's above 500,000 now in terms of the number of new homes, highest inventory levels since November 2007. So you really have to go back to the last housing bubble peak to see levels of new homes in terms of the inventory this high. And what we're seeing in terms of the month supply here is something we haven't seen historically outside of a recession. So typically you see this supply build up because you have people losing their jobs, they can't afford to buy a new home, and you'd see this new home month supply number spike. We saw that in the 1970s during that recession, early 1980s a few times, and back in 2008, 2009. The exception here would be back in 2022, and now again today, where we're seeing this supply rising, not because of a terrible jobs market, at least not yet, but because affordability is so low. So this time, so far, is different in that we're seeing the supply spike mainly due to affordability. And here's the inflection point that I'm talking about, the balance between buyers and sellers. And this is just a big gap now that we're seeing in terms of sellers outnumber the number of buyers by nearly 500,000. And Redfin has this data going back to 2013. And this is the biggest spread that they've recorded here in terms of sellers outnumbering buyers. So if you have more sellers than buyers and this spread widening, what that is likely to lead to is a lower pace of home price appreciation. And you can see that in the existing homes data here. The median sales price is now up just 1% over the past year, the slowest rate of growth that we've seen in 2 years. And if we're looking at the major cities across the US, what is the big reason why we're seeing this affordability crisis? Well, it's simply because of the gains we've seen in home prices over the last 5 years, over the last 10 years, way outpacing the increase in people's wages. And that disparity has led to the least affordable housing market in history. But if we just focus in here on the 1 year percent changes here, things are starting to change here, I would say. If you look at these percentage changes, they're low single digits in many cases. We're even seeing some outright declines in terms of cities like Tampa and Dallas. And it seems like we're at an inflection point where this number overall, and the Case-Shiller data is a few months lagging, so we're talking about April here, and we're in obviously at the end of June. So I think this is probably closer to 1% or flat. So very likely we could see in the years to come, is what I've been saying, is real home prices, so home prices adjusted for inflation, real home prices actually going down over the next 5 to 10 years to normalize the housing market. And that actually would be a very good thing, because that would mean a housing market becomes more affordable again. And just looking at that affordability picture in terms of the first-time home buyer, you could see here this spike here moving in the wrong direction, what you would need in terms of a qualifying income to buy a starting home. In 2024, that went up to over $100,000 for the first time. You can see double where it was, more than double where it was 5 years ago, back in 2020. So this is an untenable situation. You want to see, obviously, the housing market to be affordable. It's to be based on people's income. And the best way you're going to get there is by that supply coming back to the market, which should put a lid on prices, allow people's wages to catch up. And maybe we're going to see prices come down a little bit if we see this supply picture continue to increase. That's what happened after the last housing bubble peak. Hasn't happened so far because of that supply-demand situation. But if this is an inflection point, that wouldn't be out of the realm of possibility to see price declines where we see supply outweigh demand. So let's end with something positive, as we always do. It's a similar to the last section here, talking about housing affordability. And what would really help with that the most is to have more houses available for people to rent, for people to purchase. And in the major cities, what we're seeing is the start of a major conversion boom from office properties to residential. The reason why we're seeing it is because we're seeing the office vacancy rates in the U.S. hit record highs above 20%. In some cities, it's even higher than that. This is a national average of the top 50 U.S. metro areas. So obviously, a lot of vacant offices because of the transition from being in the office full-time to a hybrid model, which most companies have adopted. You don't need as much space. And so we have all this excess supply of offices, and a certain percentage of this is starting to be converted into residential. And if you look at the announcements, the expectation, if these announcements actually come true, is we're going to see a big boom in terms of these conversions. Now, the reason why we haven't seen it already is this is complicated. It's not easy to convert many of these offices to residential. It costs a lot of money, so prices have to come down, which now they're coming down for these office properties. You're seeing 30, 40, 50% declines in some cities in terms of the sale prices from a few years ago. But I view this as a big positive. The market is solving a problem here. We have too many offices for the current demand, and we have too few residential spaces for the current demand. So if this actually comes to fruition, I think it would be a very good thing for America to see more residential. And if that shift to hybrid is going to persist going into the future, we're not going to need all of that office space that's currently there. Okay, let's end it right there. Thanks everyone for joining me on the Week in Charts. Have a great week. Hit that subscribe button if you're watching this on YouTube, and I'll see you next time on the Week in Charts.